Hey traders, in this video I want to be talking about this basic concept in institutional trading called liquidity. And this is going to actually be the first video in a video series I'm going to be making on institutional trading called Institutional Analysis Concepts in Crypto. So let's just hop into the video, get this thing started. So we're just going to be ignoring what's going on right now to show you that liquidity applies on any time frame at any point in time in any market. So let's just hop into some random area in Bitcoin. Right, as you can see, I don't even know where the price levels are. Let's just go boom. Okay, let's turn this to the 5-minute and see where we are. Okay, perfect. So let's find some place where I can talk about. Okay, so first of all, if we're talking about liquidity, we first have to cover what it is before we can cover how to spot it and how to use it in your trading. So what liquidity is very simple. So what is liquidity? Liquidity is just where pretty much there's a lot of stop orders, like buy stops, stop limit orders, stop losses, any type of stop order that can be manipulated and triggered. That's where liquidity is usually going to lie. So now that we know that what liquidity is, let's move on to how we can spot it and then how we can use it. So how you figure out where liquidity is first let's find an area where there's liquidity. Oh, this is perfect. This is a beautiful example. There's going to be a hell of a lot of liquidity down here. Or maybe here, but more likely down here. So why is there a lot of liquidity over here? Well, if we're just looking at this chart, we can see that we had this redistribution and then we moved much lower. More people were going short than long, obviously, because this is an accumulation where retail is going short, but institutions are accumulating longs to push price up and fake people out. And then we had another massive just dump here. We're going to talk about that later. So this massive accumulation, there was also people that were trying to go long here for whatever reason. So the traders that were going long, right, they might have went long here and put their stop down here. And then when they saw this level being quote unquote respected, they'd feel even more comfortable, or even more people would enter the market with longs and stops below here. And what do? We just take these out, move much lower. And now this would be our newest spot of liquidity, right? Where people are putting their stop losses. And what happens? We completely obliterate this area before moving higher, right? And this would be, look at this volume on here, right? This is what the institutions are doing. They're taking your stop loss and using that as their liquidity so they can fill their long orders at a better price, right? They're selling into your stops to take out your liquidity to buy right back up. And this is like a purge of liquidity right here, or a liquidity grab. And then if you saw this, you might have put your stop here, or you might have just kept your stop here if you got long here and you saw, oh, this level was actually quote unquote might have been respected. Who knows? Who knows what retail's thinking? But eventually, even if you put your stop down here, what would happen to you? You'd still get destroyed, right? You'd still get liquidated. You would become liquidity for the institutions because of this massive sell-off, right? The institutions sold right into your stops, took out liquidity down here, and created this order block over here before accumulating as many longs as they could to bring price back up. And that is essentially what a spring is in Wyckoff, right? All these, as I mentioned in my Wyckoff video, Wyckoff is just a general schematic for or pattern for identifying institutional activity and patterns that form a lot. But Wyckoff can just be explained by just institutional analysis, right? It just sometimes helps make things a bit easier and put it into like a neat little package. But essentially, the spring in Wyckoff is just the institutions taking out all of your liquidity, all the liquidity in the market, and using that. It's called a spring because that's what takes price higher. They take the liquidity, the buy side liquidity, which would be the buy stops, right? The buy stops are actually going to be shorts, right? When you close long, you put in a short. That's how you close long. So they would take your long stops, right, buy stops, and use that as liquidity so they can get a better price for their longs and move much higher. And then again, we had liquidity forming down here, right? Now people are sure this is an uptrend. As soon as people are sure this is an uptrend and start putting their stops down here, we get obliterated. Absolutely obliterated. And then you can see the same thing happening down here where it's just manipulated. Okay, and now let's go to another area where you can spot this. Take a look at this chart and tell me, where do you think liquidity is lying? If you said the liquidity was lying up here and then up here, then you are correct. And also down here. So first, we made this up move before moving lower. And now people are going to be interested in either breakout trading, right? Once it breaks out of this range, or shorting up here and putting their stops up here, right? That's what they're going to be wanting to do. So all of those stop limit orders are going to be in this vicinity, in this area. And what's going to happen is we're going to destroy this area, or price is going to go right through this area, take out liquidity for moving lower. Classic manipulation. Easy peasy lemon squeezy for the institutions to make money. And in this case, again, both sides would have got wrecked, whether you were long or short, right? If you were short, your stop loss would have got hit, obviously, and then the price would have moved much lower. And if you're a retail trader with a retail mindset, you might have got triggered and been like, oh my god, I knew price was going lower. I should have just not put a stop loss, right? Horrible advice. Always use a stop loss. Don't go no stop loss. That's how you blow accounts. Trust me, I've blown so many accounts. It's so easy in crypto to blow your account, especially if you're trading on leverage. No stop loss. It's just a small brain strategy. And then the breakout traders also would have gotten destroyed, right? They would have gotten their trade activated up here, right? Expecting price to go higher. But instead, what does price do? It goes like this. And just wrecks them, right? And their stops would have probably been like here or something. I don't know. Breakout trading is just not a good idea, right? You don't want to be buying the highs, right? You don't want to be buying the highs to sell maybe higher. You want to be buying low and selling high. You don't want to be buying high and just expecting price to go a bit higher. This is bad RR. Where are you going to target, right? For breakout trading. It's not a good idea. So both sides would have got wrecked. And in this case, institutions would have just used that liquidity to move the price lower. And then what do? Here again, more liquidity. People would have put in their stop somewhere here, over here. And then this last down move would have taken out some stops before moving up. So now you kind of get the gist of where liquidity is lying. Now let's talk about how you can apply this very important concept into your trading, right? Because all of all institutional trading is just figuring out what the institutions are doing, and they love targeting liquidity. So let's just look at some random things. Okay, so a lot of the times liquidity isn't just going to be when there's a range, right, and there's like equal highs and equal lows forming. It's pretty obvious where liquidity is going to be, right? Above equal highs and then below equal lows, right? And we're going to take that out. But when the market is going up or down, then it's hard to tell where liquidity is. But here, if we kind of use some retail logic, we can kind of see where liquidity is, aka trend lines, right? I think trend lines are garbage, right? I don't use trend lines to trade, but sometimes you have to think like the retail to figure out where their stop losses are and where institutions are gonna try to pull price into. So if you see this beautiful little trend line kind of being created, there's gonna be a lot of liquidity below here, right? Because people are moving their stops below this trend line, which they perceive to have some sort of magical power to keep price above. And there's also going to be limit orders or maybe just market orders where people just want to get short below this trend line. So what happens is this is an area, or below this is an area of liquidity, right? And then as you can see, we just broke below the trend line and went very much lower before continuing to move higher for a while. So what's going on here? Let's look at where liquidity would be also from just a standpoint of not even looking at like where the retail liquidity is. If we're just talking about liquidity, we can also find liquidity at the highs, right? The highs, the daily highs, or just the local, wherever the highs are, pretty much. If we look at daily highs and lows, that's a pretty good way to find where liquidity is, because if people are trading on the daily time frame, right, or maybe larger time frames, those are going to be the levels where they're putting their stop losses, right? Because on the 5-minute or 15-minute, maybe after this area is destroyed, people move their stop losses to here or here. But the people who are trading on the hourly and see this and they see this thing, right? Instead of moving their stop loss up here, they'd probably just keep their stop here, and they wouldn't be exiting any trades, right? They would think that this is a reversal to go long, maybe, if they're trying to get in. And they would probably be here and with their stop down here. So this daily low would be a nice area of liquidity where we would be targeting, where price would be drawn to, right? We would take out this liquidity. And you can also see how this pretty much takes out this low here, and we take out all that liquidity too, right? Because the people who are going long or maybe trying to sell below here, it doesn't make sense for people to sell here, but oh shoot, never mind. I didn't even notice there was a wick down here. Never mind. That is some crazy price movement. Okay, let's just move forward. Okay, now let's talk about how you guys can apply the concept of liquidity to your trading to become very, very profitable. So we had this nice accumulation, tiny ass accumulation. Oh, never mind. This is on the hourly. Let's go on the 15-minute. Okay, we had this nice accumulation play here, and now we have this kind of trend line here. Let's just move this a bit forward. Let's see, what are we gonna do? Okay, here we just took out liquidity up here at the highs. Let's move on. Now where is liquidity going to be? At this high, at these highs. But also at this low, probably, when we took out liquidity down here. Okay, we didn't really have any price action movement here, so there's pretty much nothing to trade over here. Let's move on to the next day. Oh, okay, we have liquidity down here now. Look at these equal lows. And also some people who went long here. Oh, this was a nice order block. So this would actually... Okay, this is why we didn't break below here. We had this order block over here. I will talk about this in in a future video that I'm gonna make in this series. But basically, we rejected this order block. But once this order block is fully mitigated, we'll have no problem just going right through this level, right? So it's not support and resistance. There's reasons why price is rejecting certain areas, right? But doesn't mean that there's some magical line that price is going to bounce off of every time. Okay. Price keeps on trading up. This market is so rangy, and we make it back to these lows. So now whether we form like a propulsion block or reject this level, right, form a propulsion block, is yet to be seen, right? But I think it's been a couple days already. Unless this order block is some massive order and we don't expect this to rise up, I expect this to just get destroyed, right? Like either we just move right through and just move much lower, or what could happen is we just take out liquidity before moving much higher, because there's also all this liquidity up here. Look at this, right? There's all these highs where all these stop losses could be placed in stop limit orders. So we could just move a bit lower, take out these stops, take out the liquidity, and then the institutions could just buy into that liquidity and then take out the buy side liquidity up here, or the sell side liquidity up here. So yep, look, exactly what I predicted. And now we expect price to go much lower. Yup, price is gonna now move much lower. And now what you can do is you can just wait for us to take out this liquidity up there, right? Because price gravitates to levels of liquidity. So if we were trying to target liquidity down here, right, or down here, what we would have been trying to do is maybe short up here. But that would have not been that great because price could have just manipulated up here. So now that we know that there's barely any liquidity left up here or down here, and price is not going to be really gravitated to any other levels besides this liquidity up here, we can look for long opportunities. But we also have to realize that the market structure is also in play, right? So and we can also incorporate this with Wyckoff. So if we see this accumulation type thing forming, right here could be our spring. Yup. Look at this. You could have gotten here on. You could have gotten in here, right, on this order block, or you could wait for like a slight pullback, which is probably gonna occur. Okay, we got our slight pullback, right? You could have entered along right here. Stop right below these lows, right? Because we just manipulated them. It's highly unlikely that we're gonna break this and not go lower, right? If we take out these lows, it's going to be a genuine move downwards. Just like when we took out the lows where our stop loss was here, it was a genuine move downwards, not manipulation, right? So you're not going to be worried about just getting stop hunted. And look what happens. We move higher. Okay. turn this to the 15-minute. Yup, and the trade played out nicely, right? We didn't come back to this level because there's nothing for the institutions to do down here, right? And also because we created this beautiful little order block over here, and yeah, we're gonna cover that in a future video. And we did create some liquidity down here, so we manipulated that before moving much higher, but eventually we did gravitate to this level where there was a lot of liquidity. There's also some liquidity up there, right? But this level, yep, is where we targeted, and it hit our profit target. And now let's see if price moves higher. Yep, price does move higher. So I would have trailed some of the trade probably and got more profits because price does want to take out liquidity up here as well, and also up here. You know, remember what I said about daily highs and lows and how price gravitates to them? Look at this. This would have been on the daily chart a place where the stops are, right? Look at these perfect little swing highs and swing lows that just got violated. Look at this, right? Perfect. So you can always do top-down analysis, right, on the daily and then look at lower time frames. But then you also can just kind of just scroll in and realize that price is fractal. So if I just scroll in like this, I can already tell where liquidity is here, right? Those are going to be the protected, quote-unquote, protected highs, right? I don't even need to go on the daily because price is fractal. The daily time frame is just this turned into one candle, right? But by just zooming out, I can pretty much tell you, oh, here is pretty much like the body of the candle from here to here, and then there's a wick, massive wick here, massive wick here. Let's go to the daily. Yup, look at that. We can see this kind of trend line thing going on, and there's gonna be a lot of liquidity down here. Okay, now let's let price play out. Okay, there's a lot of liquidity here, right? A lot of liquidity down here. So we kind of took out some liquidity down here, but there's a lot more liquidity below this area. So let's just see how price reacts. Price is usually going to gravitate towards liquidity. So what we're going to do is we're kind of expecting price to just take this area out. We can either move lower to fill out these imbalances or just boom. I'm actually expecting price to go a little bit lower, right? Because we do have a lot of imbalance down here. I'll cover imbalance also in future videos, which I'm going to put in this series, because imbalance is also very useful in trading. Yup, we take that out. And, oh, okay. We do use that liquidity to move much higher. So this imbalance is just ignored. Okay, interesting. Actually, we didn't have that much imbalance. We just had, I guess we had from here, and then we also had, okay, we didn't have too much imbalance, but I was at least expecting us to fill some of this out. Okay. So now you can see how people are kind of tricked by this trend line, right? They're like, oh no, the trend line is now going through here, right? And this is just like a fluke mistake, some like manipulation candle, and they maybe put their stop over here, right? But just avoid trading with trend lines and you'll just be much happier. Now let's see what's gonna happen. Okay, yep. We took out liquidity at these highs. And now there's going to be a lot of liquidity up here, down here, and at these daily lows, obviously. And now we're kind of ranging, and there's going to be liquidity below and above, right? So, yeah. Whenever there's a range and volume kind of lowers, what you're going to want to see is you know that something's going to happen when you kind of see this U shape on volume, right? There was a lot of volume earlier, and it dropped off, and then there's more volume coming. So that's pretty much what's going to happen during consolidations, accumulations, distributions, that kind of stuff. Okay, right, we just took out liquidity right here, like I said, the daily lows before moving higher, right? We just manipulated those lows so that the institutions can get a better price for their longs to move higher. And now we take out liquidity up here. Before we took out liquidity at these lows, right, this looks like it was some type of resistance. This area was protected for a while, and we just violate it so easily, right? And then we also take out, oh, no, never mind, we don't take out this high. And we just use that liquidity to move lower. Just textbook manipulation here. This is just textbook manipulation. And yeah, this video is just about concluded, right? I think I talked about this stuff for a long enough time, but basically, let me just create a conclusion and just sum up the points. Manipulation is pretty much everywhere in the market, and institutions look to manipulate the highs and lows where stop losses are being put and stop limits are also being put, right? So all that nonsense about support and resistance, just throw that out of the window, because if you think it's resistance, if retail thinks it's resistance, if your grandma thinks it's resistance, if you can just draw a simple line and it bounces off there every single time, then everyone who ever bought on that line would be a billionaire, a millionaire, right? It's clearly not that simple, right? And same thing with breakout trading. You don't, if price breaks through your supposed resistance level and that's somehow significant, then why aren't breakout traders like billionaires? Of course they're not. 95% of traders are unprofitable, and that's for a reason. Retail logic, right? Just when you think an area is going to be just when you think an area is going to act as resistance, suddenly price just breaks through, manipulates those highs, and just as you think it's a breakout trade and you get in and you're all excited, you're like, we're going to the moon, they take price lower. I'm not talking about this example in particular, but that's just how trading works, right? Just when retail thinks one thing, the institutions do the opposite. And why does it work for them? Because they have more capital. They can manipulate the markets. Simple as that, right? You see how Dogecoin and that stuff can blow up, or how GME can squeeze. It's just whoever has the most amount of money gets to decide how they want to manipulate the markets. And that's just how the markets work. It's not based on trend lines. It's not based on support or resistance. It's not based on all this retail garbage, right? Not based on what your indicator says. It's simply based on what the institutions want to do with the price, right? Where, if they want to go where liquidity is and where the liquidity is going to be targeted. Oh, one last thing. I'll talk about a little tip on how do you spot where liquidity might be tapped, or which areas of liquidity are going to get tapped and which ones are likely not going to become tapped areas. So where is liquidity? Liquidity is below here, somewhere in this area. right? Now there's more liquidity down here. We made equal lows. Again, more liquidity is down here. And then we just take out that liquidity. And there was also liquidity up here, right? Because this was some type of downwards trend line. But why did we not take out the liquidity up there? Why is that? Why did we take the sell side liquidity or the buy side liquidity, but not the sell side liquidity? It's very simple. It's because we were way oversold, right? Already, and we needed to fill out these imbalances. So you also have to take into consideration the other factors in the market and price structure, because we kept on making lower lows, right? That lower highs and lower lows, pretty much, and lower highs. So sure, the institutions definitely could have manipulated and taken out these orders up here and the stop losses up there, but more likely they want to go short as well, because they feel either they have orders they still need to mitigate down here, right? Maybe they had an order block over here they want to mitigate, but they also need to fill, but the alt market also has all these imbalances that eventually need to become filled. So you have to take that into consideration. That's why you never really want to breakout trade, right? Even if you're trading liquidity, it's really hard for me to want to trade all-time highs. Like if price gets up here and breaks it, I would not get into any trades, right? Because where would I put the stop? Where would I target? It's just not a good idea, right? You want to be trading previously established ranges and highs and lows, right? So you can have amazing risk to rewards and be very confident that your trade is going to play out the way you want it to, right? You don't want to FOMO into a trade. You don't want to FUD into a trade, right? You want to have conviction into your trade and not get your emotions involved. And what does price do? It's moving lower. Just put this here. Okay, yeah. Eventually we do manipulate these highs, but you would have already got your trade here, right? This would be the trade. I scalp. I don't hold on to trade for days. This would be the trade. This beautiful trade would have already gotten hit, right? We are targeting this level, right? And the stop right at these highs. And then you would have pretty much got your trade, right? If you just targeted this low. It would have ran a bit longer, but you would have got your decent risk reward. And yeah, the trade would have played out in your favor. Of course, you could have held on to this and this would have went much lower, right? But that's not really trading. That if your stop loss is that wide, right? Or you're targeting, why would you put a stop in a place that didn't exist? So pretty much, yeah, that's just how you spot where liquidity is going to be gravitated towards. And eventually, yeah, we are going to take liquidity up here, but that's not going to be the trade that you're going to be looking for, right? Liquidity is most likely going to take out this area first, and then you're going to be looking for a trade here. And yep, that just about concludes this video. Please subscribe and like this video for more content. And I'm going to be doing a lot of live streams coming up soon, where I'll be doing live trading to show you guys just how I do my analysis and that I'm actually profitable, and show you guys proof. So that'll be really fun. So also hit the bell icon so you guys can actually get notified when I do get live, and I can answer some of your questions live in the chat and stuff. That's going to be super cool. And that's it. See you guys next time.